Good afternoon, everybody. It's the weekly economic update for Monday, November 29th, 2021. I am Raymond Dahlman, your humble host, president of DSA Financial Group. And if it's your first time watching, be sure to like, subscribe, and share with friends and family. I would certainly appreciate it. And I'm sure your friends would like that too. So hope everyone had a fantastic weekend, got a lot of rest, watched a lot of sports. There was plenty of college football and basketball for me, which is always a good thing. So hope everyone else out there had a fantastic time. And like I said, hope everyone had a great weekend. So as far as, the markets and the economy, it was kind of a rough weekend, or rough going into the weekend on the markets with the latest Omicron variant. People are freaking out. So personally, just eat right, get lots of sleep, take your Flintstone vitamins, and I think everyone's going to be okay. So now if you have 100 pounds of extra weight and you got diabetes and asthma, you might want to start changing your lifestyle. I mean, this has only been going on for 2 years. So anyways, all right, well, let's go ahead and take a peek at the weekly economic update, and we will get rolling. Make that a little bigger for you. All right. The week on Wall Street, news of a new highly virulent COVID variant triggered a market sell-off on Friday, sending stocks into negative territory for the week. The Dow Jones Industrial Average slid 1.97%, while the S&P slumped 2.2%. The NASDAQ lost 3.52% for the week, and internationals dropped 1.68%. Red Friday. Investors woke up to Black Friday to reports of a mutated COVID variant, reviving fears of potential new economic restrictions. U.S. markets were not alone, as stock prices in Europe and Asia also tumbled. Friday's market action saw declines in economic reopening stocks such as travel and leisure, cyclicals, financials, and energy, while some of the so-called stay-at-home stocks and pharmaceutical stocks experienced gains. Yields retreated amid a flight to safety and the potential that this turn of events may lead to a slowdown in the Fed's bond tapering program and a delay in contemplated rate hikes. Prior to Thanksgiving, the markets had been choppy, but largely trending higher for the week. While yields had moved up, the renomination of Fed Chair Powell. Powell renominated. President Biden announced last week that he was renominating Jerome Powell to serve another term as chairman of the Federal Reserve Bank, ending market speculation surrounding his renomination. President Biden cited the need for stability and independence in time of uncertainty in making his decision. While Powell's renomination faced resistance, Senate approval appears likely. Coincident with Powell's renomination, President Biden also nominated Lael Brainard, a member of the Federal Reserve Board of Governors, to serve as vice chair. Investors can soon expect further Fed nominations by the Biden administration to fill vacancies created by term expirations and retirements. All right. Economic data coming out this week. Tomorrow on Tuesday, we'll have the Consumer Confidence Report. Wednesday, the ADP Employment Report and ISM Manufacturing Index. Thursday, jobless claims, and Friday, employment situation and factory orders. There's a few companies reporting earnings this week. Salesforce tomorrow on Tuesday, and Hewlett-Packard. Wednesday is Okta, Snowflake, and CrowdStrike. And Thursday is Marvel Technology, Dollar General, Kroger, and DocuSign. All right, so that's everything for the weekly update. It's a pretty light week. My ghostwriters evidently took the weekend off and didn't write any, neat little stories. So let's take a quick peek at Yahoo Finance, see if there's anything that's jumping out at us. Let's see. Stock recoup some losses as Biden says Omicron is not a cause for panic. I would agree that it's probably not a cause for panic for those of us who've survived the last 2 years and not had any problems. Let's see. Walmart CEO, we will have a really good holiday season. Well, probably. There's still a lot of money in people's pockets. And let's see. Yeah, not a whole lot. Soros is buying stocks. China cash flowed through a Congo bank to former president's cronies. We'll see if that news picks up any steam. Do you have to pay capital gains on a home sale? Most of us already know that. So, all right. Well, let's go over to a couple articles I wanted to review with everyone. First one comes from John Malden. It's titled Worth 1,000 Words. And I'm going to go ahead and start here. Second paragraph. The COVID retirement boom. Where did all the workers go is a recurring question lately. This chart has a partial answer. The thin blue line shows retirees as a percentage of the U.S. population. As you would expect it turned higher after the first baby boomers turned 65 in 2010. The red dotted line shows the smooth trend for that period. Let's see. Then came 2020, and as we can see by the red arrow, the percentage of retirees rising sharply above the previous decade's trend. COVID-19 appears to have motivated a bunch of early retirements, which seems to be accelerating. Everyone has their own reasons, but we suspect this isn't entirely health concerns. Some retirees probably saw the big portfolio gains as markets surged and decided they could afford to retire earlier than planned. The percentage may look small, but this divergence represents something like 3 million excess retirees above what the prior trend predicted. That's substantial labor force shrinkage. So let's go back up here to the chart. So, and you can see the blue lines is the percentage of retirees, and then the red dotted line is the baby boomers. So you can see the split here over the last year. So that might be a big part of. I apologize. My dog is hacking over here. Be quiet, Barney. This might, explain why there's the 4 or 5 million person gap in, from employed Americans, 2 years ago versus where we are today. So that might have have some, maybe the reason. God, can't think of words. All right. Next paragraph, massive distortions. The common thread between rising inflation and growing supply chain problems seems to be increased U.S. consumer goods demand. People want to buy more stuff because they have higher incomes. This chart illuminates the timing of recent income growth. We can see the real disposable personal income was rising at a generally steady pace in the years leading up to 2020. Then came the pandemic, after which we saw 3 sharp income peaks. These coincide with the 3 rounds of stimulus payments most Americans receive, not me. The first in 2020 and the 2 more in early of 2021. So you can see here, personal incomes, like the mountain climber on The Price is Right. And then we see this giant jump, the first one in 2020, and then it recedes. And then again, so looking here, this is, tailing off a little bit. So we'll see what the disposable income trend looks like later on. So, all right. And disposable income dropped after all 3 payments, but far faster than the 2 in 2021 installments. The last few months show it roughly back on the pre-COVID trend. If personal income goes back to this pace, the supply chain problems and inflation may also recede. For now, we can only observe massive distortions with consequences not fully understood. All right. Next paragraph, gas times 42. You may have noticed rising gasoline prices this year. Really. This is a function of rising crude oil prices since gasoline is refined from oil. In theory, these 2 prices don't necessarily move together, yet one simple trick produces a chart showing their close connection. Simply divide crude oil's price by 42 and plot it against the U.S. Average gasoline price, and you get this. So you can see the crude oil is the red, the blue is the gasoline price, and they do fairly much move in tandem. So as crude prices begin to recede, if we see that in the future, I know every Friday I talk about the amount of rigs that are online. We're still probably 150 to 200 oil rigs to get back to where we were 2 years ago. So paying attention to this, will certainly give us a clue of where prices are going to go long term. So. And then the last, let's see, car buying confidence. Speaking of sharp divergences, here's a doozy. Each month for decades, the University of Michigan surveys have asked consumers if they think now is a good time to buy a car. The latest data shows a sharp decline in confidence. So you can see, just here in the last couple of years, it has really, really slid. You can see such declines happen before. In every case, they coincide with a recession until now. Now, consumers are losing confidence a year after the brief COVID recession ended. The difference may be that the survey questions don't identify why people think it's a bad time to buy cars. In today's context, maybe because they've tried to buy a car and couldn't find the model they wanted due to microchip shortages or other logistical issues. Confidence may return once inventories normalize, but it's hard to know when that will be. All right. So, and then the last here is poverty lines. This map shows the U.S. poverty by state. These colors indicate the percentage of each state's population below the poverty line. The least impoverished state is New Hampshire, while Mississippi is the poorest. But with inflation and other stats, the raises measurements issues. For one, it doesn't consider cost of living. High cost of living places like California and Hawaii may have more struggling residents than their poverty rate suggests. Nevertheless, this map shows yet another way in which the U.S. remains sadly divided. All right. I think that was it that I wanted to really cover here. So, all right. So I'll attach that if you want to read it in full. You're welcome to do so. And then the last article I wanted to go over is from First Trust, riding the COVID roller coaster. And let's begin. On Friday, news of a new COVID-19 variant identified in South Africa and the announcement of a new travel restriction sent markets reeling. This is obviously not the only variant, and it won't be the last either. In our opinion, it's not the new variant that's the problem, but the government's potential reaction to it. Oil prices fell 13% on Friday, pricing in a new potential round of lockdowns. We're obviously not scientists. But what seems clear is that vaccines have underdelivered on their promise of ending the pandemic. Yes, relative risks for hospitalizations and death are reduced, though not eliminated after the jab. But fully vaccinated individuals can still get and spread the virus. This means zero COVID strategy that the public health officials have been pursuing since the pandemic began needs to change. At this point, what seems less likely is that COVID will gradually become like the flu, where there is a vaccine booster available each year, depending upon what strain is most likely to be prevalent. Providing the public with accurate information about risk factors surrounding the age and comorbidity is more important than ever. However, our fear as economists is that certain urban areas in the U.S. could be struck in a cycle of fear, with each new variant leading to more draconian measures. This is where policymakers and individuals with disproportionate influence live, and their mindsets have become gradually divorced from the rest of the population. Just look at packed stadiums at college football games. All right. Most importantly, is this how people want to live? Economic planning for businesses has become impossible. Individual travel plans can be disrupted at any moment. Maybe you are fully vaccinated and you're not overly concerned about mandates, but what about when boosters become required to maintain your fully vaccinated status? Dr. Fauci recently hinted that this would be the case. Where is the off-ramp to normal life at this point? Fortunately, we think widespread shutdowns are unlikely in response to this or any variant. Recent election returns in New Jersey and Virginia suggest the American public is fed up with the overly cautious policy mix chosen by officials in the past year and a half, including widespread shutdowns and tough mask rules. Another round of shutdowns could turn a political environment that we believe favors a Republican wave in 2022 into a Republican tsunami. Democratic political strategists will be cautioning their party leaders not to court fate, although it's not our base case at this point. It's not outside the realm of possibilities that another harsh shutdown would lead to a filibuster-proof Senate majority for the GOP in 2025. Put it all together, and we think investors need to continue to be ready to ride the COVID roller coaster. Given record high profits, we still believe stocks are relatively cheap. That doesn't mean that there won't be dips, though, or even corrections. But when that happens, they should still be considered buying opportunities. So, all right. So there was one other thing I wanted to, I know with all the volatility that we've been seeing over the last few weeks, especially picking up, the VIX is a very good indicator to pay attention to. So, looking at the VIX, typically, if it goes over 30, that is normally a good signal that things are about to fall apart. So if we scroll back here and we can see when's the last time it significantly went over that 30 mark. It was the end of February last year. What was happening at the end of February last year? Oh yeah, COVID. And then if we go a little further out, and you can see the last time it went significantly over, hey, look at that, 2009 or 2008? What happened in September and October of 2008? Oh yeah, the Lehman crash. So what I'm looking at here is just really paying attention. I have an alert set for myself that when this climbs over 30 to, start making, evasive actions, it's time to head for the lifeboats. So, that's one thing that you, as, someone out there just in, a layman who's, watching these videos and trying to pay attention to what's going on in the world, this is a very good indicator, like I said, to pay attention to. So came really close the other on Friday, but it has significantly subsided already. So again, pay attention to the VIX, pay attention to the longer term trends, and you should probably be all right. So, all right. Well, that's everything I had for today. My doggies are getting anxious. I don't know if you can. Come here, Jake. Come here. Come here. Show off my little man here. Come here. Stand up. Stand up. Oh, hi. Say hi to everybody. This is Jake. He is the Deputy Director of Security here at DSA Financial Group, and he's my little friend. We're going to go play outside. He's going to go chase the balls up and down the hills for a little while. So, like I said, if anyone has anything that they need from me, don't hesitate to reach out and give me a call, smoke signals, email, whatever you need. And I'll definitely be back with the weekly wrap up on Friday. And I'm also going to start as of tomorrow, the Liberty Call, which is going to be a daily, kind of market recap of what's been going on that day. Any news. I'm not going to send out an email every time it goes live. So what I would suggest, if you want to watch it on a daily basis, either favorite it in YouTube or Facebook, whichever place you typically watch it, so you get an alert. But I'm going to try to have it about 20 minutes after the market closes, so that'd be about 2:20 Mountain Time. So adjust your watches accordingly. So, but that's everything I have for today. So have a great week. Be sure to go out and get your exercise and your sun. I already got my PT in earlier before I started this video, so had to sit down and rest for a while because I was all sweaty. But like I said, get your exercise in, eat right, take your vitamins, and stay healthy. That's my best advice right now in this current climate. So talk to you later and have a great week. Bye-bye.